Stock picking is something that many people want to learn. And for a lot of new guys, if you are not exploring all your big ass names abroad and you only look at Singapore, there's a natural gravity to some of these big companies, right? Like your big banks, SQ, Singtel, Sembcorp, all these guys that are supposedly household names, huge ass, but not performing very well, huh? So today, I decided to bring on a great friend of mine to talk about some of these business fundamentals of these big name stocks and why are they not performing well. Through this process, we have distilled some core wisdom towards picking dividend stocks, finding good businesses, and not be all excited about growth names and big names. So welcome back. Welcome to another Chills with TFC session. In this series, we hope to bring on interesting, relevant people to help us learn better from various perspectives. Life is not always about learning from people that you already agree with. Perspectives shape a rounder thinker. So in our pursuit of the life we love or managing our finances, well, our guest for today requires no introduction. He is the investment content lead of Singapore's leading personal finance platform. And if you have not heard of him, I don't know what you've been doing. You must have seen his articles around. So let's welcome Sudhan from Seedly, who, by the way, also worked for a writer for Multifool prior. So enjoy our time together. You've brought up this point of management. Management. There's a lot of discussion on management. And from what I understand, actually management here, in Asia or in Singapore is not as impactful as good management in the US. Right? So I want to hear, your thoughts about quote unquote good management here. Like how impactful, how important is it, having good management in Singapore?
I think all companies, it's good to have good management because at the end of the day, they are the visionaries. They have the plan for the company, especially founder-led companies. They know where they want the company to go and they have so much of passion in the business itself. Like they really want to make it grow. So I think management is important, but I feel more important is also the business fundamentals. Like, for example, you can have a very good manager in a lousy business, but the business is just going to be lousy all the way, most of the time. Yeah, there are of course caveats here and there, but in general, yeah. So yeah, I think management is important, but more important is the business fundamentals as well.
Okay, so then when we talk about business fundamentals, right? If we look back at Singapore, fundamentally, in the STI, right, the banks form the biggest, of essentially the index and the market here.
Correct.
Right, I think close to 40%
That's
of the whole index is the banks, right? So how solid is the banking business here?
Okay, I think in Singapore, yeah, like you rightly mentioned, banks, the DBS, OCBC, and UOB, they make up 40% of the Straits Times Index, and the other 27 companies are just like the rest. So yeah, but the banks in Singapore, they are super strong. They're fundamentally very well capitalized, strong, and I think they also learned from the '09 crisis. Even back in '09, the banks were strong, but now they have learned from the crisis and even become stronger. And I feel the banks in Singapore are fundamentally very strong and they won't go bust in a sense. Yeah. So, and the whole Singapore economy relies on the banks.
Okay,
Yeah.
but even if they don't go bust, right? So if we talk about the business fundamentals, right? How do the banks actually operate like their business, right? Try to help us understand because the banks sound like a very simple business, like just lending money, but actually it is, multifaceted and pretty complex from the bank, right? So help us understand a little bit, like how should we evaluate, like whether is the bank, well capitalized or is it a good bank to own?
Okay, so basically banks make money through this thing called the net interest income. So which is basically the difference between the interest they charge on loans. For example, let's say you take a housing loan or business commercial loan, they charge interest, and the difference between that loan and the interest they give on deposits is how banks make money, the net interest income. And yeah, fundamentally that's how it makes money for all banks. So, but other than that, so net interest income makes up most of their revenue, total income. Other than that, they make money through these investments, insurance, selling insurance, credit card fees, late payment fees, credit card, annual fees and stuff like that. So these are other ways that banks make money. Some of the banks also advise companies, corporations on, let's say they want to go public, they want to have an initial public offering. They advise the banks on how to do it, the whole process, and then they take a fees out of it. So, but fundamentally, mainly they make money through lending out loans.
Yes.
Yeah.
That's the biggest bulk of their business, right?
Correct.
Which is why capitalization is important, right?
Yeah.
But what is capitalization?
Okay, so basically, to make sure that the banks are strong businesses, before I go into capitalization, I will talk about some of the indicators that to look out for. The main indicators to look out for is like net interest margin. This is basically similar to operating margin for a normal non-banking company. So the net interest margin shows the average interest margin that a bank is earning from its borrowing and lending activities. So that's one thing to look out for. So the higher the net interest margin is, better it is. But for this year, last year's results, 2020, the net interest margin came down mainly because the U.S. Federal Reserve has been cutting rates, to boost the economy after the COVID crisis. Yep. So that's one net interest margin. Second is return on equity. So basically, this tells how effective a bank's management is in maximizing profits from a shareholders' capital. So ROE, same for non-banking companies. It's a very good metric to analyze how strong company is and how well management is doing its business well, whether it's doing its running its daily operations well. So you asked about management. So to assess the management's quality, this is another way to look at it. Look at ROE. Yep. Another ratio is the non-performing loans ratio. Basically, it's when a borrower is unable to pay off the loan, it adds on to this non-performing loans ratio. So
Bad debt, right?
yeah, bad debt basically. Yeah. So the lower the NPL ratio, the better it is. Yeah. And yeah. So capitalization you mentioned. So basically, how strong in a simply put way, how strong the balance sheet is. Yeah. So does it have good enough cash cushion to ensure there's no bank run? Everybody goes withdraw their funds, and then the bank is like left to go bankrupt or something. Yeah. So to ensure there's no bank run. So in that sense, I think Singapore banks are very well managed. All the three banks, and the MAS is also coming down hard on the banks as well. Singaporeans know for the banks to give out good dividends. So last year MAS
Famous.
yeah, very famous. Like
Yeah.
banks.
Yeah, you want to buy bank dividend,
Yeah,
right?
correct.
Yes.
Yeah. So like it was one point in time, I think DBS was giving 5% dividend yield. So it's like almost like a REIT kind of a dividend distribution yield. So yeah, banks were famous for giving high dividends in Singapore. So because of that, a lot of retirees, income investors invested in banks. But last year, because of COVID, MAS said that we have to cap our dividends to 60% of your previous year's dividends. So your 2020 dividends only can be 60% of 2019's dividends. So that made banks give out lesser dividends because of the cap. Yeah, logically, and because of that, the stock prices of the banks actually fell. Yeah, but investors should realize that all these banks are actually super strong. They can continue giving the 2019 dividends as the full dividend, and even add on some more for 2020 because they are really very strong, well capitalized. And even MAS has said that the move by them, right, is a preemptive move since the banks already have strong balance sheets. Yeah. So in a way it's kiasu lah. Just
And it's a one-off thing, right?
yeah, it's a one-off thing. So
Okay.
so it's good lah. It's good that the regulators are stepping in to help Singaporeans and help everybody in the economy as a whole to recover as well and to ride through the crisis. So I'm very grateful for that for the Singapore government. I'm not like promoting government and something like that, but I'm really thankful for what we have gone through in Singapore, and our government managed to curb the crisis instantly, almost instantly, compared to other countries that are still suffering and stuff. Yeah. So good governance is also another thing to look out for as an investor in the country. Yeah.
Yeah. But the thing about, high dividends, right? It's usually pretty synonymous with low growth. Like
Yeah.
the companies are not growing, that's why they're not reinvesting their capital, and then they just give you a dividend, right? So that
Correct.
you kind of hang out and stay with them.
Yeah.
Right. So how do you kind of balance this thing then?
Yeah. So in general, that what you say is true. When they give off high dividends, it may mean that there's not much growth left. But there are companies that are giving high dividends in Singapore and also have got good growth. One example is Micromechanics. They have been giving out good dividends, growing dividends, but their yield is also respectable, 3-4%. Before the run up in share price, it was giving like 4% dividend yield, and it's still growing with semiconductor market. So Micromechanics is involved in the semiconductor industry. This is still a growing company, but it's still paying out good dividends. So what happens is that it just grows so much. There's so much of cash cash coming in that they may not see a need to reinvest into the business, so they can return back to shareholders. So in terms of dividend, if you are looking at dividend companies, there's a whole suite of things to look at to analyze dividend companies. But yeah, in general, it may not be always be true. If it's high dividend paying company, you may still have growth. So it's just how you are going to pick it out. Yeah, it's not easy to pick it out, but there are such companies.
Like you said, there are some pointers, to evaluating dividend companies, right? So
Yeah.
how do we go about doing that?
So there are mainly three criteria to look at. One is the dividend payout ratio. Another one is make sure the company has strong balance sheet, more cash than debt. And the third one is to ensure the company is growing, basically. Because if you want growing dividends, you have to make sure the company is growing in the first place. Yeah. Yeah.
Yes.
Yeah. So these three things. So I will touch on the last point first. So growing companies, growing revenue, profit, and this thing called free cash flow. So ensure the business is strong. So this will make sure that it can grow year after year, revenue wise, profit wise. Most of us will know what's revenue and profit, but there's this thing called free cash flow, which is basically the cash that comes in to the company, and after netting off all your expenses to pay off your factory upkeep and all this stuff, which is called capital expenditure. So basically, it's cash flow from operations, from your operating activities minus your capital expenditure is what you get is free cash flow. So with this free cash flow, what companies can do is basically
And these are all one-liners in the FS, right? Financial statement. It's very easy to find them.
yeah.
It's
So
not as complicated as what people think
Correct,
it is,
correct,
right?
correct,
Because
correct.
we're just throwing out all these technical terms. But
Yeah.
actually, if you go and read the financial statements, there's a one-liner that clearly says this, right? You could just plug the number if you need to.
But yeah, it simply can be obtained simply from the statements. But for the free cash flow, you have to do some simple maths, just a
Yes.
subtraction.
Yes.
Yeah. So just financial statements 101. How to find the free cash flow is basically go to cash flow statements. So there are three statements that make up the financial statement. So the income statement, balance sheet, and the cash flow statement. So for the free cash flow, just go to the cash flow statement and look at this line called net cash from operating activities. There's this number. Then just below there'll be like purchase of plant, property, and equipment. Yeah, so that's capex, capital expenditure. So the A on top figure minus the bottom figure, you get C, cash flow, free cash flow. Yeah. So
Which
yeah,
essentially means extra cash, right? Extra,
yeah.
there's no real use for it for now,
Correct,
kind
correct,
of thing.
correct. It's
Yes.
basically like you get your income
Yeah.
as a
You
salary
minus
employee.
everything, there's an extra sitting
Yeah,
around.
basically the savings.
Your
lah.
savings, right?
Yeah,
Okay.
correct, in a way. Yeah, so savings that for individuals are free cash flow for company. So with your savings, you can do other things. You can like maybe splurge on luxury goods. You can you can use it to invest in the stock market. So, but for companies, what they can do is with this free cash flow, they have to decide as well, just like us. What they can do is basically one, reinvest in their own business, get the money and put it back into their own business. That's one. Two is to pay off debt if they have debt on the balance sheet, pay off the loans and stuff like that. Three, they can buy back their own shares, so they can go to the stock market and tell the stock market, hey, I want to buy back X number of shares. So it will improve a certain few metrics down the road if you do that. Yeah, we won't touch on that. Fourth one is basically dividends. What can you do is pay dividends to shareholders. So what this means is, like you mentioned earlier, they may not see the need to reinvest in their own business. They may not have that much growth. So what they can do is pay dividends to shareholders, because shareholders can then decide what to do with the money. Yep, they can reinvest into other companies, or they can,
You can buy more shares, of the
or
same
like-
company.
Yeah.
What have you not, right?
Yeah, correct. And basically, when you reinvest the dividends, you make the compounding even faster. Yeah, in the stock market. So look at growing free cash flow, because that's indicator of rising dividends as well. There's a chance to pay higher dividends if there's higher free cash flow. So that's one. So rising revenue, profits, the free cash flow. Two is make sure this company has a strong balance sheet. So what I like to look out for, ensure the company has more cash than debt on the balance sheet. So inversely, if you have more debt than cash, basically it means like if economic recession comes, you're going to be in trouble. The bank's going to be hounding on our backs, pay off our loans. We need the money back and stuff like that. So and protect yourself first as an investor. So protect the downside before looking at the upside. Protect yourself by ensuring the banks have strong balance sheet. This is both in terms of good times or bad times. The market can have a bull run for 10 years, but ensure that you invest in strong companies. Yeah. We don't slack off with your investing just because there's a bull market. Share price surely go up lah. No need to look at all this. Yeah.
Yes.
Yeah. Make sure always protect yourself as an investor. So I'm a very conservative investor. So these are the things I look out for. So strong balance sheet. So more cash and debt. Even if there's debt, ensure that the debt is not exorbitant and highly leveraged. The company is not highly leveraged. So that's two. Three is dividend payout ratio. So basically, it's a ratio where the dividends, you can take the dividends there by the earnings per share. Yeah. So dividend per share there by earnings per share, or in a more advanced way, dividend per share there by free cash flow per share. So that's in a way more accurate. So mathematically, if it's 100%, it means that
They're giving
whatever,
out everything,
correct, yeah, whatever
all the
earnings,
extra. Yes.
correct, yeah, whatever earnings the company is getting, this paying out to shareholders. So it's not reinvesting into the business. So these kind of companies are the mature companies, the super mature companies. For example, your Johnson and Johnson, your Procter and Gamble in the US, like super mature companies that may not have that much growth. But if you want growing companies at the same time growing dividends, you must have ensure that the dividend payout ratio is below 100%. So what I like to look out for is at least below 80%. So yeah, anything above 80%, I wouldn't really want to invest as a dividend company.
You still want to see that they are putting money into growth to grow
Yeah.
their business, or whether acquire other businesses.
Correct. Yeah.
Okay.
So
Is this a concern when companies start to do parallel acquisition, where they start to acquire other businesses to grow instead of growing their own business?
I think it depends on the business itself. Some companies acquire to grow, but some can organically grow like year after year, year after year. But personally, as an investor, I like to look at companies that grow organically, basically within themselves. Don't need to look outside, because at end of the day, when you don't have any companies to acquire, then no, your growth might just stop or falter. Yep. So I like to look at companies that grow within them internally. Yeah, there's a strong tailwind in the industry. So they can just keep on growing without acquiring other businesses. But doesn't mean acquisition is not good if it's done for the right reasons. Let's say this company, they want to grow into adjacent businesses that to make it a stronger company to basically diversify their business. I think it's okay. Yeah. So it's a case on case by case
Case on
basis.
case, very art, right? It's not
Yeah.
that sciencey.
Yeah, correct.
But one of your metrics that you talk about is debt, right? As long as the debt, compounded on this is not too much. It's not too crazy also.
Yeah, basically don't leverage yourself, highly leverage yourself to acquire another company. Do small bolt-on acquisitions, they would say, stuff like that. Yeah, for example, SGX is good. Just recently announced a few acquisitions, just to expand their reach. For example, they bought a FX company, I think BitFX or something. Yeah, and Scientific Beta. So these kind of companies, they are just acquiring small acquisitions just to entrench themselves even more into the market. So I like this kind of small acquisitions just to, like extra growth, to give extra growth and stuff like that. So that's one thing I look out for. Yeah. So but back to the dividend payout ratio. So 80%. Why I like to have companies look at companies below 100% payout ratio is that, let's say for example a recession comes, companies paying out 50% of their dividend, for example, and having a high dividend yield still. If a recession comes, if the earnings drop, at least they can still maintain the dividend and still have it's just maths. Yeah.
Yeah.
Even if 50%, right, let's say the earnings drop and then your ratio goes up to 80%, they can still maintain the same absolute dividend, just that the ratio will go up. So there's this margin of safety. In engineering, I was from engineering previously, so we always have this margin of safety. Make sure the bridge, when you build it, if you can wait, you can tahan one ton of people weight, right? Don't just build it for 1 ton. Build it higher, 1.5 ton or stuff like that. Yeah. So there's this margin of safety built in investment. So another way to have margin safety is basically look at strong balance sheet companies. Even in like companies that have long runway for growth, is also have, in a way, is margin of safety as well. Yeah.
But growth is a whole different discussion.
Yeah.
That's
right.
It's a very, very complex, different discussion. We'll do that another time. But on the topic of like strong companies and good dividend payouts, right? I think there are a lot of famous names here. Like big names like SQ, like SPH, like StarHub, and all these are like household names. People know them, and they come up so often in like retail investors discussion. When I hear people talk about it, I'm a little turned off. Okay, but I want to hear your thoughts, because I saw you wrote an article, about some of these big names that are like household names, but they're actually fundamentally not that strong, other than their brand stickiness.
Yep. So I wrote an article on this 5 companies I would avoid in 2021. So these companies are like Keppel, Singtel.
I think you avoid more than 2021. Avoid them a lot longer.
Oh, yeah. Avoid it all the way, like, in a sense. Yeah, I avoided them all the way. These five companies, but I made a mistake with Sembcorp Industries. That was back many years ago. I wrote about it as well in the lessons. Yeah, so these are the companies I would avoid investing in, basically because yeah, there's a famous saying in the market saying that all these companies won't die. It's like
Yeah,
government
yeah,
back,
yeah.
it's Temasek back and stuff like that. But okay, they won't die, but they won't thrive either. They won't grow either. In my opinion, so there's always this opportunity cost. So let's say there's two companies, company A, company B. Company B is like Amazon, Zoom, the DocuSigns of the world. Company A is like, for example, faltering companies that can't really grow. Which one would you put your money into? Company A may not die, but company A may not grow either. Your money will just be like, you put in $1,000, your $1,000 10 years later will still be $1,000. But compared to company B, you put in $1,000, 10 years later your $1,000 might be tens of thousands of dollars. Yeah, it just compounds, grows and grows and grows. So there's this opportunity cost involved. So in the short term, you may not see it. Long term, if you have like 5 years, 10 years, 20 years, 30 years, 60 years to retirement, it's really a huge game changer.
Yes.
So I avoid these companies. By all means, like they brought Singapore to where it is, like your Capital Corp and Sembcorp, your SIA, stuff like that. It puts Singapore on the world map. SIA. Whenever you say SIA, people know it for its brand, for its customer service and stuff like that. But as an investment, I wouldn't really put my money into these kind of companies. Yep, I would rather put it into strong companies that can grow. Yep.
So let's be a bit more case specific. Like, why not SIA?
Okay.
SIA is super popular. Everybody tell me won't die one, government back, blah, blah,
Yeah.
blah, blah. Yes.
Correct. Yeah. So SIA is another good example. So I wrote an analysis of SIA, I think back in last year March. I think the first analysis. So that article really did very well because it was like a bear case against SIA. Like why I wouldn't invest as an investor. It's my own perspective. Yep. So what I wrote there is basically SIA is operating in a very price sensitive industry. As a traveler myself, I wouldn't. Whenever I want to travel, I go and do scanner, search all the cheap tickets, right, like Jetstar or AirAsia and stuff like that, and go for the cheapest ticket. We're all budget conscious, especially when you want just to go to Bali. You wouldn't want to take SIA, pay like few $100 more just for the comfort, extra. Good morning, sir. We don't want to pay extra for that. So I don't mind not having not having that. Like I don't mind not having entertainment. I don't mind not having the food within for the next 1-2 hours. Even if I want food, I just pay $5 extra and stuff like that. So we being very price conscious, especially individuals like me, I want to get the cheapest ticket basically. Yeah, so I go for Jetstar's, Asia's, and stuff like that. So the industry itself is very price competitive. Yeah, there's so many airlines vying for the consumer dollar. So yeah, I think Richard Branson has this quote, famous quote where he says, "You want to be a millionaire, be a billionaire, and start an airline." Yeah, so it's known to be a competitive industry. Yeah, so in that sense, economics wise, it doesn't make sense to me to invest in it. And if you look at it further deeper, for SIA especially, because it wants to be world class, top class, it wants its planes to be new. Because if your planes are new, you need lesser maintenance. I was from the aerospace industry, so I kind of understand this industry a bit more. So if your planes are newer, you need lesser maintenance and stuff like that. The planes won't spoil as fast. Yeah. So the average fleet age for SIA is around 5 to 6 years. So that means every 5 to 6 years they need to pump money to buy new planes, and planes don't cost millions of dollars; they cost like billions of dollars. Yeah. So when I mentioned capex earlier, so what SIA does is basically uses money, uses capex to buy new airlines. So theoretically, they can't reinvest in their own business because the cash is tied up to buy airlines, and every 5 6 years they have to do this upkeep, this maintenance, these purchases. They can't reinvest in their own business, and there's not much growth left. Yeah, so that's another thing. And another aspect is also there's a lot of debt in my opinion. That's a strong balance sheet. So yes, if my memory doesn't fail me, it's like 80% debt to equity ratio. It's quite high in my opinion. Yeah. So yeah,
But
another
they have built this integration of hardware, right? Where they fly SQ and then 5 to 7 years later it goes to Silk Air, and then after that it goes to Scoot, right? So
Yeah,
they have like a brand integration there.
correct.
Like, do you think that is an advantage in their space?
Um, it could be as an advantage as a group for SIA itself to compete against other airlines, but basically on a group level, it's still the whole investment thing doesn't make sense to me. Yeah, it may be good for them to compete with the other Qantas or like Emirates and stuff like that, but as an investment, it's still back to the economics.
Do you hold any airlines to begin with?
No, I don't.
Okay, so generally you are not pro this sector because of the competitiveness in the margins and the high capex
I'm
in
actually
this
involved in
space.
this sector through SATs.
Ah,
Yeah,
yes, I like that company. It
yeah.
says share with us more. Yes, share
Yeah,
with us more
so
about sets.
so in the aerospace industry, there are different value chain. If you put it that way. So there's airlines, there's the maintenance arm. In Singapore, is the listed one is SIA Engineering and ST Engineering through its ST Aerospace arm. Then the third one is this services business, for example, sets. So they do ground handling for passengers for the airlines, basically load up your baggage and do security checks. They also have the food arm where they provide food for the airlines, and not only airlines, they're also in non-aviation businesses. So, for example, in China, they serve the fast service food restaurants and stuff like that. So with COVID, actually, the non-aviation business kind of picked up. I mean, did well in a sense compared to the aviation business. And also since they have the cargo business as well, this now the vaccine drive is also helping them to cushion the business. So I think SETS as a whole is in a much better place than a pure airline itself. Yeah, even though SIA is SETS, SIA is a major customer of SETS. I feel the aviation industry will pick up. We won't know when. It will pick up. People want to travel. Like there's always this pent up demand, especially for Singaporeans. We love travel, love traveling. We love to travel. Yep. So the aviation industry will pick up. Just that the thing is when. So in the investment space, if we are convinced about the business, we have to hold on to the investments and maybe even reinvest more money into the company, into by buying stocks. So I feel SETS is a strong company. When the recovery comes, it has all these non-aviation services that is doing and revenue that's now coming in ready. And when the whole economy picks up, there'll be more businesses coming in from non-aviation side as well. So all this will come together and help the company. And it has a strong balance sheet as well, so it helps. Yeah, so it helps to tide through this storm for them.
Yeah, for sure. Like
Yep.
I think sets is a way
Yeah.
better buy than SIA. Okay, but we're not recommending, right?
Yeah.
Education, entertainment purposes
Yeah. Yeah.
only.
Just my
So,
own experience. Yeah.
yes, own experience, right? Go and read on the company. I think it's a pretty interesting company. Yeah, but
Yeah.
if we go into this other big vertical of telecoms, right?
Mm.
Like in the space of telecommunications, you also wrote about like why you will not own StarHub,
Yeah.
right? And I'm just kind of curious, like why do you not look at the telcos as a big business?
Okay, so telcos, Singtel, StarHub, and previously M1 was listed. Now it's unlisted, privatized. Previously, before I think many years ago, it was like very strong dividend companies. I think like maybe in 2011, 2012, around.
Margins are very high in this business
Yeah,
in the past.
correct. In the past, because we all know like what happened right to the industry. So
Yes, yes.
basically, in the
Circles
past,
Live, you mean?
yeah,
Circles Live
circles lah.
versus Big Telco, right? The
Yeah,
ad.
correct.
Yes, yes.
So I still remember. I think many years ago, many years ago, when Star was launched, they had this airship in the sky. I think during NDP, one of the years, they had this advertisement on the. Do you remember?
Really?
Okay, so
I
basically,
don't remember.
yeah, so basically they launched an airship to advertise their services. I think when they started off, so during NDP, it was just floating around on top. I think National Stadium or Padang or somewhere at that year.
Floating
So
somewhere, lah, somewhere.
yeah, so you can see this airship. So those times people were locked into telcos, right? For example, when you buy a phone, you have this
Oh,
2 year
yes,
contract,
yes.
and you only can go to M1, Singtel or StarHub. You can't. There
Yes.
wasn't Circles Live. There wasn't like TPG, Giga, and stuff like that. Yep. So those days were, I think, it's gone. Yeah. Now there's so much of competition, and ever since Netflix came into the world, I mean, into people's minds, I think it's another game changer for them. So they had this SIM card business, I mean this phone line business, and they also had this pay TV business, for example, StarHub. So, but when Netflix came in, you actually can see when you go back to the I actually pulled out all the numbers for Motley Fool previously. You actually can see when Netflix entered the space in Singapore, StarHub's pay TV average revenue per user actually dropped. We really can see the drop. Yep, year after year after year. Yeah. So and I think StarHub was very slow to the game. I think they felt that Netflix wouldn't be a challenge to them, and then they were slow to move in and stuff. But then now we know, Netflix is like dominant. Even Singtel is affected, StarHub is affected, and now there's Disney Plus. So yeah, so I think it's just the how it is now. So the days of StarHub, Singtel being a good dividend payer, especially StarHub, a lot of people own it for the dividends. I think it's over. And I also did analysis showing that I talked about free cash flow, the dividend payout ratio. You actually can see, you could see it coming. Dividend cuts were coming because when you analyze the numbers, you can see it's unsustainable, the dividends. Yeah, so I also wrote about all this stuff for Motley Fool, even for Seedly as well. So if we will just do a bit of more homework, more research, just plug in numbers here and there, you can see it coming as well. Yep. So yeah, we just have to do the research, not just listen to people talking about it, your friends or
Yeah.
the media. Just
Yeah.
do your own research, due diligence, and
Yep, and the dividend research business is not that difficult.
correct.
Right, compared to the growth, you have
Yeah.
to plot the charts, plot the possibilities. That's a lot more complicated.
Correct.
Like I think, like you've broke down, right, the dividend understanding. It's not that, um, it's a lot simpler, lah,
Correct.
relatively, right? So then,
Yeah.
if we bring everything together, right, to look at the Singapore markets, do you think people should, like young people trying to invest or people that have some money, should they be vested here or should we look abroad?
Personally, I would say I personally have invested in Singapore. I still have investments in Singapore. I use my CPF, my funds to invest in the ETF, STI ETF. I still believe Singapore will grow, but may not be in the in the stage of S&P 500 or Nasdaq. But Singapore will still grow. The banks will still grow, making up 40% of the index. Even though they're like laggards like Singtel and stuff like that. But I think generally the Singapore economy will do well. I mean the market will do well. And the STI ETF is known for, because the banks are paying good dividends, and the ETF also, because of the how it's made up, it also gives alright dividends yield wise. So I'm okay to just park some money in my CPF in STI ETF, but mostly of my cash portfolio is in the US. So yeah, it just depends on where you want. If you are a retiree, if you want dividends, I think Singapore is a great place. But if you're young, like you mentioned, if you're young, you want to have more growth, I think you can look into the US, China market, Hong Kong market. There's so much more growth just by the size of the businesses listed there versus here.
So much more exciting, right, over
Yeah,
there.
yeah, that's right. Yeah,
Okay, that's cool. Thanks for sharing. I think we learned a lot of good juice today. Thank you.
thank you, Reggie.
Thank
Thank
you.
you for having me.
Awesome. Hey, I hope you learned something useful today and truly appreciate that you took time off to better your life with the Financial Coconut. Knowledge is that much more powerful and interesting when shared, debated, and discussed. Join our community Telegram group, follow us on our socials, sign up for our weekly newsletter. Everything is in the description below. And if you love us, want to help us grow, definitely share the podcast with your friends and on your socials. Also, if you have some interesting thoughts to share or know someone that you want to hear more from, reach out to us through hello@thefinancialcoconut.com. With that, have a great day ahead. Stay tuned next week and always remember, personal finance can be chill, clear, and sustainable for all. Okay, so I'm just going to ask you 3 questions that we ask everybody.
Okay.
Okay, and the first question is, what is one of your core life principle that you hold close to?
I would say be grateful for things in life, and because I think every single person in the world has played a small part, directly or indirectly, in your well-being. Yeah. So we may not know it, but the world is keeping us alive. Yeah, basically. So just be grateful for life. Be grateful for what you are, and just every day you can just say thank you to certain things that you do, that you have done for the day. Yeah. So, yeah, I think gratitude is a very, very important thing. Yeah.
Cool, awesome. So then, what is a personal finance advice that you feel needs to be more propagated?
I think financial knowledge, investing knowledge, I would say a lot of people think that investing is only for the elites, for the the fund managers or the portfolio managers, the BlackRock of the world, Goldman Sachs of the world. Actually, it's no, like everybody needs to learn to invest, because basically if you put money in your bank, leave money in the bank, now it's even lower interest rate, less than 1%, and it will never ever go to like above what the stock market will give you. Yep. So everybody has to invest just to beat the inflation monster. Yep. Because if you put the money in the bank, it's just like basically putting your money in the Kong Tin biscuits. No difference. Yeah. There's no difference.
Do people still eat Tin biscuit?
No, but I still eat the square biscuits.
Okay,
Yeah,
okay.
it's still nice. But it doesn't come in the tin biscuits form anymore, but it's in the packet form. But it's the similar understanding. Putting money in the bank maybe it gives you like, for every $1,000 it gives you like a few cents or a few dollars. But yeah, but you have to invest in the stock market, even if you don't know how to read companies' financial statements, even if you don't know how to like look at pick individual stocks, you can still invest through ETFs, through robo advisors. All these businesses are doing great jobs, great job to propagate investments. So even at Seedly, we have a reviews platform for people to make the decisions on which, for example, broker is the best, which robo advisor is the best. So they can just go on to Seedly and find more information on this as well.
Nice, cool stuff. Stay invested.
Yep,
Okay.
yep.
And the last question is, which part of your life are you giving extra focus now?
I would say my family. Yep. So now I have a son. So
So cute.
yeah, thanks. So yeah, just family now. Yeah, I think fatherhood changed my perspective about life as well. Just being grateful. I think bringing a child to the world is a miracle in itself. Like just like I tend to think a lot. So but when it comes to when I think about childbirth, or even conceiving a child and stuff, even without our input, our thoughts, there's the gestation period going on for 9 months. You can't fasten it, you can't slow it down. It just happens as and when the nature's way. So looking at that as that's totally changed my mind. Like I can't describe in words. You just have to go through it to know. Yeah, I think a lot of fathers will understand, mothers will understand what I'm trying to say. Yeah, but childbirth is it's a whole new, gave me a whole new perspective that I wouldn't imagine. Like I didn't know how I came into this world, but through a child I could see how like I came into this world, how how I was brought up, how my name was given. Even giving a name, I felt at that point in time is a label. I'm labeled as Sudan, just like this is a mic, there's a table, there's a chair. So they were all going around the labels, and these labels are creating so much of ego, so much of tension. It's you against me, that against this. So yeah, I just feel just it's a total life changer for me. Yeah, childbirth.
Nice,
Yeah.
nice. One day I'll get through that.
All the best.
Thank you
Thank you,
so much.
Reggie.
Awesome.